Hey there, tax-savvy friends. Welcome back to the channel. If you've ever sold a house, stocks, or even some vintage comic books and found yourself wondering, wait, how much am I going to pay in taxes on that? Today's your lucky day. We're diving deep into capital gains taxes, what they are, how they work, and most importantly, how they affect your tax rate. Plus, I'll give you a few tips on how to minimize or even avoid paying too much. Now, I know taxes aren't the most exciting topic, but stay with me, because by the end of this video, you'll understand how capital gains can impact your wallet, and maybe even how to keep more of your hard-earned cash. So grab a snack, sit back, and let's break it down. But before we start, be sure to hit that like button, subscribe to the channel, and share this video with a friend who could use a little tax relief. Let's dive in. First things first, let's make sure we all understand what capital gains are. In simple terms, capital gains are the profits you make from selling something that's appreciated in value, like stocks, real estate, or even your grandma's antique furniture that you finally decided to part with. Imagine you bought a stock for $1,000, and a few years later you sold it for $1,500. That extra $500 is your capital gain. It's the profit you made from selling an investment. But here's where the IRS comes in. Capital gains are taxable, which means you'll owe taxes on that $500, and potentially even more depending on your overall tax situation. Now, not all capital gains are created equal. The IRS distinguishes between short-term and long-term capital gains, and trust me, it matters. If you sell an asset you've owned for 1 year or less, those gains are considered short-term, and you'll pay tax on them at your ordinary income tax rate. So if your regular income puts you in the 24% bracket, then your short-term capital gains will also be taxed at 24%. On the other hand, if you hold on to your asset for more than 1 year, then your gains are considered long-term, and the tax rate on those gains is typically much lower. We're talking 0%, 15%, or 20%, depending on your income. This is where things get fun. The government actually rewards you for holding your investments longer. Who knew, right? So let's talk numbers. How much capital gains tax can you expect to pay? This depends on your tax bracket, which is based on your total taxable income, including ordinary income, like your salary or business income, and any capital gains you're reporting. For long-term capital gains, here's the general breakdown based on your taxable income in 2025. 0% tax rate for single filers making $48,350 or less. $96,700 for married couples. 15% tax rate for individuals making between $48,351 and $533,400. $96,701 and $600,050 for married couples. 20% tax rate for anyone making more than $533,400. $600,050 for married couples. Yeah, I know the numbers can feel like a math class, but stay with me. If you fall into the 0% category, you don't pay any taxes on your long-term capital gains. Pretty sweet, right? But if you're on the other end of the spectrum, you might be staring down a 20% rate on those gains. So, every $1,000 gain could cost you $200. Ouch. Here's where it gets interesting. Capital gains tax can affect your overall tax rate in ways you might not expect. Because capital gains are taxed differently from ordinary income, it can actually lower your effective tax rate if you're able to qualify for those long-term rates. Let me explain. If your income from wages or business profits puts you in a higher tax bracket, but you also have some long-term capital gains, those gains might be taxed at the lower 15% or 0% rate instead of your higher ordinary income rate. Basically, the more long-term capital gains you have, the lower your overall tax bill could be. So, in a way, capital gains tax can be a good problem to have. Alright, now that we know how capital gains work, let's get into the fun stuff, how to minimize or avoid capital gains tax. There are a few tricks of the trade that can help you keep more of your profits. First up, hold on to your assets longer. The longer you hold an investment, the more likely you are to benefit from those lower long-term capital gains rates. So, next time you're tempted to sell, ask yourself, am I really ready to part with this asset, or could I hold it just a little longer to save on taxes? Another strategy is to use tax-advantaged accounts like a Roth IRA or 401k. If you hold investments inside these accounts, you can avoid paying taxes on capital gains while your money grows. It's like putting your gains in a tax-free box. Also, consider tax loss harvesting. If you have investments that have lost value, you can sell them at a loss to offset the capital gains you've made elsewhere. This can help reduce your taxable income and lower your tax bill. It's like a magic trick. Buy low, sell low, but reduce your tax burden. Who knew losing could be a good thing? Now, let's talk about real estate, because if you're selling your primary residence, there's a special capital gains exclusion that can save you a ton of cash. If you've lived in your home for at least 2 of the last 5 years, you can exclude up to $250,000 in capital gains if you're single, or up to $500,000 if you're married and filing jointly. That's right, $500,000 in tax-free gains. And no, it's not a joke. The government will actually let you keep all that profit as long as it's your primary residence. So let's wrap this up. Should you be worried about capital gains tax? Well, not necessarily. If you're strategic about your investments, hold for the long term, and maybe use a few tax-saving tricks, you can keep your tax bill as low as possible. And if you're just getting started, don't worry. This is all part of the learning process. And hey, if you ever find yourself confused by the tax code, don't hesitate to reach out to a tax professional. They're the ones who understand all the little tax loopholes that can help you save. All right, there you have it. Everything you need to know about capital gains tax and how it affects your wallet. If you enjoyed this video, be sure to give it a thumbs up, and don't forget to share this with anyone who might be selling assets soon, whether it's a house, some stocks, or even that car you've been thinking of unloading. And if you want to stay in the loop for more tax tips, investment strategies, and ways to save your hard-earned money, hit that subscribe button. Thanks for watching, and I'll see you in the next video. Let's keep those taxes low and our wealth growing.